It is important for investors to fully realize the potential cost implications for their retirement of having insufficient exposure to equity markets over time. While markets are no doubt volatile and can have extended periods of no return, case in point being the last 2 years in South Africa, attempting to time when returns will come for most investors is too tricky, and importantly, the costs of getting it wrong can be no less than devastating to one's long-term retirement planning. A case in point is a simple study of the JSE over the last 20 years. An individual who invested 100 Rand in the JSE back in June 1997, 20 years ago, would today have 800 Rand in value, excluding the dividends he's received. Another individual who invested 100 Rand at the same time, but withdrew their funds and went into cash before each of the 10 best months, which is only 4% of the total time period in question, and then subsequently reinvested, would be left with only 260 Rand. Such is the impact of compounding over time and the risk of missing out on returns when they come. Importantly, this exercise obviously doesn't take account of missing the worst months, and hence could be deemed to be an extreme example, but it is also worth noting that human psychology suggests that most investors tend to pull their money after a bad experience, not a good one. In 4 out of the 10 months that we referred to above, the market in the preceding 3 months had declined by more than 10%, so the likelihood of investors bailing was high, only to miss out on subsequent good returns. Time in the market is more important than timing the market.